If you woke up this morning holding shares of DVAX Technologies, well, this is the deep dive for you.
It absolutely is.
We're going to unpack the massive, sudden influx of value in your portfolio by digging into the source material on one of the biggest biotech buyouts of the year.
It's a huge headline, and it's confirmed now. The French pharma giant Sanofi has agreed to acquire DVAX. DVAX.
Right.
This isn't just market chatter anymore. It's a done deal. And the number is staggering. A $2.2 billion total valuation.
And the terms are clean. I mean, that's what's so critical for investors here. Sanofi is offering $15.50 per share.
All cash.
All cash. So our mission today, we dug into the analysis reports to focus on really three things. First, that immediate financial shockwave. Second, the strategic why. I mean, what asset was worth $2.2 billion to Sanofi?
Right. What's the prize?
And finally, the really practical part, the crucial, maybe 12-cent decision that every single DVAX shareholder is facing right now.
You know, this deal, it's a perfect case study in modern pharmaceutical M&A. It's a rapid, high premium move. A global player just decided to instantly seize market dominance in a really profitable category. It wasn't about haggling for months. This was about paying an urgency tax, really, to get a key revenue stream like today.
Okay, let's start right there with that urgency. The analysis we looked at, it really highlights the immediate financial impact. You can just see it on the DVAX stock chart.
Oh, yeah.
I mean, you go to bed holding a stock that closed at $11.13.
And you wake up, and it's trading above 15.40.
That is the kind of overnight move that is just so rare. It's what the market calls a massive 40% GIPUP.
Right, and that instant sort of permanent re-rating of the company's value, that tells you everything. It tells you how undervalued DVAX was and just how badly Sanofi wanted this asset.
So let's analyze that premium. The price is $15.50, but what does that number actually reveal about Sanofi's thinking? Because that is a hefty, hefty increase.
It is. The analysis shows Sanofi paid a 39% premium over DVX's closing price right before the news hit.
Almost 40%.
Yeah, and paying a 40% premium, that is not standard procedure. When Big Pharma does that, it signals they value one specific, irreplaceable asset very, very highly.
And they were willing to pay to skip the line.
They were willing to pay the inconvenience tax, as the report puts it, to just remove any thought of a rival bidder even stepping in. They basically flashed the cash at the door and ended any potential bidding war before it could start.
That makes a lot of sense, paying for speed and exclusivity. But does that mean the market was just asleep at the wheel here? Or was DVAX management just, happy to cash out?
Well, it's a bit of both. But it really highlights the difference between how the public markets value a smaller biotech and how a giant global company values a single proven product.
Okay.
Big Pharma is always looking to buy growth. They want immediate secured revenue rather than going through those long, expensive, and frankly risky internal development cycles.
So for Sanofi, $2.2 billion just bought them guaranteed market share and years of save time.
It's like they're saying, we don't want to build it. We just want to buy the finished profitable engine.
Exactly. And that's a perfect lead-in to the strategic rationale. What was that engine?
What was the engine that was worth $2.2 billion?
Yeah, what did Sanofi really want? This clearly wasn't just about diversification. This was a targeted grab for one specific thing.
Absolutely. The analysis makes it crystal clear. The entire acquisition was driven by one single product, DVAX's hepatitis B vaccine, Hepalisa B.
And the reports consistently describe it as
best in class. That's the key phrase.
That best-in-class label, that has to be the core of the whole justification. For anyone listening who isn't, tracking vaccine development day to day, why is it considered so much better than the competition? I mean, from guys like GSK or Merck.
It comes down to two things, really. Improved efficacy and a much, much more convenient dosing schedule.
Okay.
The older Hep B vaccines, they typically require 3 doses over 6 months.
6 months is a long time. People drop off.
Exactly. That creates huge compliance issues. A lot of people just don't finish the series, which means they're not protected.
And that compliance risk is revenue risk for the company.
Precisely. Now, Hepalisa B, in contrast, it's just 2 doses, and it's done in 1 month.
Wow.
On top of that, the analysis points out it shows superior protection rates, especially in tougher populations, like older adults or people with other health issues.
So Sanofi didn't just buy a vaccine. They bought the highest efficacy, lowest compliance risk product on the entire U.S. market.
That completely changes the dynamic. It's not just another product, it's a competitive weapon. It solves a real-world logistics problem. So how does a U.S.-focused product suddenly become worth billions to a French company?
Because Sanofi already has this massive global machine, right? Their supply chain, their sales force, their regulatory teams, they span the entire globe.
Right.
DVAX proved the science and they built the U.S. market share, but they were pretty limited in how fast they could go global. Sanofi sees Hepalisa B and thinks, that's a guaranteed product we can plug into our existing machine tomorrow. So if I'm hearing this right, DVAX built a better rocket, and Sanofi is just providing the massive launch pad and all the fuel to send it worldwide.
That is the perfect analogy. This move lets Sanofi instantly dominate a huge growing market without all the R&D spending and risk of trying to build their own. They're just buying revenue and skipping years of challenges.
Let me push back on that for a second, though. If the product is really that good, and DVAX was undervalued at $11, shouldn't management have held out for more? Are we sure Sanofi didn't just get a bargain here despite the big premium?
That's a great question. It's a critical piece of the analysis. The premium seems high compared to the stock price, sure, but it might actually be a huge discount compared to the drug's long-term global revenue potential.
So why sell?
Because for a smaller company like DVX, trying to build a global distribution network and fight off Merck and GSK, that is incredibly expensive. They probably decided that taking the guaranteed cash now was a better strategic move than facing the huge cost and uncertainty of trying to become a global pharma giant themselves.
So Sanofi's capital was just the fastest, least risky path for the vaccine to reach its potential.
That's it. And then there's the bonus asset, the thing the analysis says Sanofi basically got as a throw-in.
Oh, right, the shingles vaccine candidate, Z1018.
Exactly. It has potential, but the report confirms Sanofi essentially got this for free in the context of the deal. It just reinforces the whole story. The $2.2 billion was all about the proven, profitable, best-in-class Heplis-B revenue. The rest is just, speculative gravy.
It's the ultimate big pharma move. Acquire growth, don't build it.
When you have billions in capital, sometimes the fastest way to add value isn't inventing the next thing, but buying the best thing that already exists.
Okay, so let's pivot. Let's move from the deal itself to the practical decision facing you, the investor, right now. You've just locked in a 40% gain. What do you do with those shares today?
This is where it gets tactical. The deal is confirmed at $15.50 a share. But as is pretty standard with M&A, the stock today is trading just a little below that, say at $15.38.
So there's a 12-cent gap. It feels like nothing after a 40% win, but that little difference forces a choice, right? Wait it out or sell now.
And according to the analysis, this choice really boils down to two clear options for a regular investor. Option A is hold until closing. We can call this the safe route.
Okay, so if I hold, I'm guaranteed to get that full $15.50. What's the catch?
The pro is you maximize your return, yes. The con is your capital is tied up. This deal isn't expected to close until Q1 2026. So you're locking up your money for, 3 to 4 months just to get that extra 12 cents?
3 to 4 months for 12 cents. Break that down for us. Why do people call that dead money?
It's dead money because it's sitting there earning almost nothing. That 12-cent gain from today's price is a tiny 0.8% return. Over several months, if you annualize that, it's a terrible return. You could probably earn more in a high-yield savings account.
And there's always a tiny bit of risk.
A tiny, tiny risk. The deal gets delayed for regulatory reasons or something, and you have to wait even longer for that tiny return.
Okay, so that's option A. What about option B? Sell now, the trader route.
Option B is simple. You just sell right now at the market price of, say, $15.38. You lock in that huge 40% profit, the cash hits your account in a couple days, and your capital is immediately free.
So let's talk about opportunity cost, because that's really the deciding factor here. If I sell now, I have $15.38 to reinvest. If I wait 4 months, I have $15.50.
And think about it like this. Waiting 4 months for 12 cents is an earnings rate of less than 1%. But if you take that $15.38 today and put it into another opportunity that grows just 5% over those same 4 months, you've already far outpaced the 12 cents.
Right.
The analysis is very clear on this. So for anyone who isn't a dedicated arbitrage fund, the guys who make millions closing that tiny gap on huge volumes of shares, that 12 cents is just not worth the time.
That's a really important distinction. An arbitrage fund sees the 12 cents as guaranteed, risk-free profit on massive volume. A regular investor should see it as a minuscule return on locked-up capital.
Exactly. The verdict in the source material is definitive. Take the win now. Capture the massive gain, and immediately move on to the next opportunity where your capital can work much harder for you.
It makes complete sense. You've had a home run. The smart play is to immediately rotate that capital into something with higher potential, not wait around for less than a single percentage point.
So what's the big takeaway from all this for you, the learner?
Well, the DVAX buyout is just concrete proof that successful biotech investing often means finding quality assets with real proven revenue.
Like Heplis-B.
That the wider market is just underestimating. It proves that buying quality assets that solve real problems, it really does pay off.
Absolutely. The buyout validates the asset, but now it gives you, the shareholder, a new strategic challenge. You've captured the gain, and now you have to deploy that capital. The rotation of that value is what matters most now. You have to be forward-looking. Sanofi bought a singular, high-quality product to plug into their global strategy. The successful shareholder now needs to be looking for the next emerging company with that same kind of unique, undervalued revenue-generating potential.
And that leads us to our final provocative thought for you to think about. When a $2.2 billion acquisition is driven almost entirely by a single, best-in-class, specialized product, what does that imply about the future of M&A? I mean, is the future about finding these highly profitable niche assets? Rather than building broad, diversified portfolios in biotech, is specialization now king?
A powerful question to consider as you put that freed-up capital back to work.
That's it for this deep dive. We hope this unpacking of the DVAX deal helps you move forward with confidence and a clear strategy. We'll catch you next time.